Next guest sees anything but negative growth next year. Joining us now, Evercore ISI founder and senior chairman Roger Altman. It's nice to see you. Happy holidays and New Year. Welcome back.
Same to you, Scott. Thanks for having me.
Inflation's falling everywhere except for Major League Baseball, as we just learned yet again. You sat down and you said, unbelievable data. Should the Fed declare victory?
Well, let's step back for a second. What's unbelievable is that, as was said earlier on this network, 85% of economists at the beginning of the year thought we'd be in recession. Honestly, I thought we probably would be in recession too, so I'm not any different. And not only are we not in recession, but the economy is gliding along at a really good pace. Unemployment rate's 3.7%. Obviously, markets have been soaring. And the outlook for 2024 seems to me to be quite good. So the interesting question is, why? Why was everybody so wrong? I personally think historians will say, it'll take a few years, that it was the pandemic, the uniqueness of the pandemic in terms of its economic effects. Because in my view, at least, the pandemic caused this inflation. Americans sitting at home, unable to go out, a lot of liquidity, obviously unable to spend on a lot of normal things, and splurged on goods. Demand for goods soared, whether it was a bike or a grill or whatever it was. Supply chains couldn't keep up. Inflation soared. Then as Americans began to finally go out, they still had a lot of liquidity. They had a huge pent-up demand for experiences, whether it was just a night out at a restaurant or a trip. And the demand for that also soared. Supply side couldn't keep up, and so forth. Now, on the other side of it, supply sides have fully loosened and basically returned to normal. Labor supply has continued to creep up because a lot of people who left the labor force on account of the pandemic have slowly but surely come back to it. Labor participation rate just very recently got back to its pre-pandemic level. And so a normalcy is returning. And I think history will say that while those on the transitory side of the argument didn't think it would take nearly this long, they were fundamentally right. It was inherently transitory, just took, a couple of years. And that all this came about because of the pandemic and fundamentally ended up with a soft landing on account of the pandemic.
Is it time to cut rates?
Not yet, because I think if the Fed will want to see the inflation rate come down a little bit further. But, we're forecasting, Krishna Guha at Evercore is forecasting up to 5 rate cuts next year. So I don't know whether it's going to be 4 or 5, but it's going to be probably a year of easing. And, Steve Leisman and others were debating this morning just after the inflation figures came out, how far down interest rates should come to square with the new inflation data. The answer is, 150 to 200 more basis points, at least on like the 10-year. So should be a good year. I mean, growth should be steady. Interest rates should be lower. There's 2 big risks. Obviously, one is geopolitics. One is the election. Who in the world knows how those are going to play? But it should be a good year, other than that.
What's going to be the best argument to push the Fed on their dots even more in terms of rate cuts? Is it going to be about corporate taxes expiring or commercial real estate? I mean, we're hearing a lot today about risks of undershooting, given today's data.
Well, if I was sitting on the Open Market Committee, I would just want more good data before I made that very profound shift. I don't think there's anything in it for the Fed to try to do this early, because however small the risks are, if you get it wrong, you ruin your whole progress here. So take your time, and I don't think it's really more than that, Carl. I mean, there's soft spots in the economy, like you say, commercial real estate, and other factors. But I think it's more about locking it down in terms of inflation progress and not assuming too much early.